Okay, so picture this. It's March 2026. A new conflict suddenly flares up and it sends these massive shockwaves through the global economy. And caught right in the middle are two totally different markets. You've got old school, traditional oil, and then you have new school, digital crypto. They're on this wild, volatile collision course, and it's absolutely fascinating. So how do they each react, and what does it tell us about where finance is headed? Let's untangle this whole thing.
So before we can even get into the market craziness, we have to set the stage. You got to understand the world we were living in at that moment. By late February 2026, things were already tense. Geopolitical tensions in the Middle East were simmering, big global powers were involved, and honestly, the whole situation was just a powder keg waiting for a spark.
And man, did things unravel fast. Look at this timeline. On February 27th, JP Morgan is actually putting out a report saying oil prices are going to fall. That's the mood. Then, literally one day later, bam! Tensions explode. On March 9th, we get another huge escalation, throwing this massive dose of uncertainty into markets everywhere. And by the end of the month, everyone is just scrambling, trying to figure out what it all means.
So why all the panic? What was the big deal? Well, it all boils down to this one narrow strip of water, the Strait of Hormuz. Think of it like the main artery for the world's oil supply. A huge chunk of global oil has to pass through this tiny choke point. So any threat of disruption here, any chance it could get blocked, that threatens to cut off the world's energy supply. And that fear, that very real possibility, is what sent the markets into a total tailspin.
The first domino to fall? Well, it was the one you'd expect. As all those fears about supply started to bubble up, the price of oil did exactly what history has taught us it would do. It just exploded.
And to really get how big of a shock this was, you need to know where we were starting from. Just before this all kicked off, JP Morgan was forecasting Brent crude at a pretty calm $60 a barrel for the year. That was the baseline, in a normal, stable world.
Yeah, well, that stable world was gone. In March, the price of oil didn't just rise, it surged, hitting a high of $119 a barrel. We're talking nearly double the forecast. That's how immediate and how brutal the impact of this fear was.
I mean, just look at that number. A 60% jump in a single month. That is huge. And this wasn't just traders getting jumpy. This was driven by a real, calculated fear of a 10 to 12 million barrel per day deficit in global oil if that choke point, the Strait of Hormuz, was actually compromised.
All right, so while oil was following a pretty familiar playbook, the world of crypto was busy writing a completely new one. Its reaction was complex, it was counterintuitive, and frankly, it's the central puzzle we're going to try to solve here today.
Right, the oil story makes a lot of sense, it's pretty straightforward. But this is where things get really weird. What in the world happened with Bitcoin? In a moment of global panic, when investors usually dump anything that looks even remotely risky, how did this famously volatile asset respond?
At first, it did exactly what you'd think. Panic hits, investors get scared, they sell risky stuff. So Bitcoin dipped right along with everything else. But then, something totally unexpected happened. It didn't just stop falling. It whipped around and staged this incredibly powerful and rapid rebound that pretty much caught everyone off guard.
And here's where it gets really mind-bending. During the absolute height of the crisis in March, Bitcoin didn't just bounce back, it actually outperformed gold. Yeah, gold, the textbook safe haven asset that people have been running to for thousands of years in times of trouble. And as Bitcoin's price blew past a staggering $71,000, that whole digital gold idea, it wasn't just a niche theory anymore. It started to gain some serious traction. For a growing number of people, it looked like Bitcoin was acting as a hedge, not just against inflation, but against the instability of the entire traditional financial system.
So this all leads to the million-dollar question, right? Is there some kind of direct string connecting the price of oil and the price of Bitcoin, or are we just looking at two completely separate universes that got shaken up by the same earthquake? Let's dig into the evidence.
And the answer is, well, it's messy. You've got folks like Binance Research coming out with a report saying, nope, no real long-term connection here. They're independent. But then you look at other analyses from just the year before, and they found a strong correlation at certain times. So what gives? It tells us the relationship isn't fixed. It changes.
So maybe we're looking at this all wrong. Maybe it's not a direct rope tying them together. Think of it like this. A big oil price shock is like a giant boulder dropping into a lake. It doesn't just hit the spot where it lands. It creates ripples that spread out everywhere. Those ripples are things like shifts in investor sentiment, changes in how much money central banks are pumping into the system, and big investors just reshuffling their entire portfolios. So Bitcoin isn't moved by the boulder itself, but by the waves it creates. Okay, so now that we kind of get this complex, indirect relationship, where do we go from here? Well, the future of both of these markets really seems to be hanging on the answer to one single question. Does this conflict get worse, or do we see a move towards peace?
The entire global market is basically standing at a fork in the road. One path is continued conflict. The other is a return to peace. And where we go next could look dramatically different depending on which path we take.
Okay, scenario 1. The conflict keeps going. This is the ugly one. Some analysts were warning oil could spike to an insane $150 a barrel, which would push global inflation up to over 4%. For crypto, it would be a real tug of war. On one hand, you'd have pressure from investors dumping risky assets, but on the other, its story as a safe haven outside the traditional system could get stronger than ever.
But what if we go down the other path? Scenario 2, peace is achieved. Suddenly the entire picture flips. Oil prices would likely fall, and fall pretty significantly, taking a lot of that inflationary pressure off the table. For crypto, this could be pure rocket fuel. With stability back, some analysts projected Bitcoin could push past $75,000 as the world's focus shifted from chaos back to fundamentals.
You know, at the end of the day, what this whole crazy episode in March 2026 really did was force all of us to ask a really fundamental question. When the foundations of the world feel like they're shaking, our old definitions of risk and safety kind of get thrown out the window. And in this new world, the real question isn't just about oil or crypto. It's about what any of us can truly count on as safe anymore.